Good afternoon, everyone. So I hope you're having a great day so far. So my name is 𝐓𝐡𝐞, and I'm also with the research team at iFAST. So I'm going to wrap up today's sharing with a quick introduction to our managed portfolios, otherwise known as FSM MAPS, and then we'll move on to the lucky draw, which I'm sure that all of you are very excited for. So first things first, what exactly is MAPS? MAPS is our online managed portfolio solution that is designed to take the complexity out of investing. So it can build, monitor, and rebalance your portfolios for you so that you can invest with confidence and without the stress. So to achieve this, we have a team of over 10 portfolio managers and analysts who are based in Singapore. We closely monitor markets and also contribute our best ideas into the portfolio. And on top of that, we are also supported by a wider regional research team that are based in locations such as Malaysia, Hong Kong, and even China, who we can rely on for further insights if necessary. So this is also a service that we have been running for close to 8 years already, since late 2016. So let me share a few ways on how MAPS can add value to your investment journey. So first of all, as a managed portfolio solution, what we aim to deliver is professional management on a discretionary basis. So this means that as an investor, you can leave all the day-to-day investment decisions to our experienced team who handle everything, beginning with the portfolio construction, to the product selection, and even the rebalancing. And although this is a discretionary portfolio, rest assured that every action that we take, it is always in your best interest and aligned with the investment objective and risk profile of said portfolio. So the second advantage is diversification. Our portfolios, they are not only diversified across markets and sectors, but also in terms of products as well. Inside our portfolios, we use a mix of unit trusts and ETFs to strike an optimal balance between passive and active management. So by combining UTs and ETFs into this portfolio, MAPS, it brings together the best of both passive and active strategies. So UTs, for instance, they excel in markets where there's greater inefficiencies and the fund managers can exploit them, uncovering hidden opportunities. On the other hand, ETFs, like you've heard all day, they provide broad-based exposure at a very low cost. So the third reason is accessibility. Investors can start investing in MAPS with as little as 500 Sing dollars for their first lump sum investments, and subsequent RSP investments are only at $100 each. And on top of that, MAPS offers you a wide range of choices with 2 different types of portfolios, income and growth, each with 5 different risk profiles for you to choose from. So whatever it is, there is something for you. All you need to do is to choose which portfolio you're comfortable with, and we will do everything else for you. Now, since inception, our approach for MAPS has always been the same, which is to maximize risk-adjusted returns over the long term through value investing. But what does this mean exactly? So first of all, what we aim to achieve is proper diversification. Successful investing to us is about building a resilient portfolio that can weather different market cycles. So we ensure that our investments are spread across various asset classes, geographies, and even products to manage risk effectively. So second is a focus on fundamentals and valuations. So this means that we don't chase short-term market movements or speculate on price movements. Instead, what we do is we invest in high-quality assets that are backed by strong fundamentals and other structural factors, with the goal of delivering sustainable returns over the long time. So valuations, earnings growth, and other structural factors, so these things, they play a central role in our investment process, helping us to identify opportunities that are not only compelling today, but also sustainable in the long term. And finally, we have to invest with a long-term perspective. So after all, investing, it is a marathon, it is not a sprint, which is why it requires patience, discipline, and most importantly, a long-term mindset. Now, this slide over here shows you an overview of our portfolios. So starting with the portfolios, investors can choose between 2 options. We have income and growth. The difference between the two lies in how dividends are treated. So income portfolios, they aim to pay out dividends on a quarterly basis, while growth portfolios, they don't distribute any income. So this distinction, it is achieved by selecting the distributing share classes for the underlying funds in the income portfolio, and for the growth portfolio, we select the accumulating share classes. So it's important to note that the dividends that we are paying out, they are not guaranteed, nor do we have a targeted payout rate. We simply distribute whatever dividends that the underlying funds we receive from the underlying funds at the end of every quarter. So in contrast, the growth portfolios, because they are accumulating share classes, so any dividends that are received, it is automatically invested into the fund already. So for each of these portfolios, we offer 5 distinct risk profiles ranging from conservative all the way to aggressive. So you can see that the conservative portfolio, it has a neutral allocation of 10% equities and 90% fixed income, prioritizing capital preservation over growth. If you move one step up the risk ladder, you have the moderately conservative portfolio with 30% equities and 70% fixed income. Balance is 50-50, so on and so forth. So these 5 portfolios, they are designed to suit the needs of most investors, and you can just pick one that best aligns with your risk appetite. So for instance, if you're someone who is relatively younger, you have a longer investment horizon, higher risk tolerance, then I think you might be suitable for one of the more aggressive portfolios. On the other hand, if you are just a conservative investor looking to make some modest returns, perhaps beat inflation, then you may be suitable for the one of the more conservative portfolios. Now, let me share a little bit more about our investment process and how we construct our portfolios. So broadly speaking, there are 4 main steps, as you can see on the screen. We start with the inter-asset allocation, then we go on to the intra-asset allocation, product selection, and finally, review and rebalancing. So starting with the inter-asset allocation. So this basically refers to the split between equities and fixed income. And as I already mentioned, this is largely determined by the 5 risk profiles that we have already. But as markets evolve, we also need to make decisions on whether or not should we overweight equities or fixed income or to stay neutral. So these decisions, they are guided by a range of factors, including our market outlook, relative valuations between fixed income and equities, and also both the prevailing and the expected interest rate environment. So all these factors, they factor into our inter-asset allocation. So there are, of course, limits to how much we can adjust. And these limits, they help to ensure that during bull markets or bear markets, we cannot shift entirely into equities or fixed income, like what most investors would do. So this also helps to maintain the portfolio's intended allocation, and it ensures that it stays aligned with its longer-term investment objective. So once this is done, we'll move on to the next step, which is the intra-asset allocation. So intra-asset allocation basically refers to how much we allocate to each market within each asset class. So for equities, for instance, at the very beginning, our asset allocation was actually based on a GDP-weighted approach. But since last year, we have made the switch to a more conventional market cap-weighted approach, mirroring the allocations of the MSCI AC World Index. So this shift, it reflects our evolving global outlook, and it also ensures that our portfolios remain in step with broader market dynamics. And as you can see from the chart, developed markets such as the US, Europe, and Japan, these have a relatively larger allocation compared to emerging markets. These are also markets that our research team is positive on. So one distinct aspect of our portfolios is that we have carved out a 20% allocation to the digital economy, recognizing its significant impact on global growth and also the long-term investment opportunities within this segment. So the digital economy refers to economic activities that are driven by digital technologies, things like the internet, AI, so on and so forth, and it encompasses industries like cloud computing, digital advertising, and even essential hardware services like semiconductors. So one of the core reasons why we like the digital economy is because of the structural tailwinds behind this segment. So examples include rising digital adoption and the global shift towards a more data-driven, tech-enabled industry. So for instance, if you look at the big tech companies in the US, many of them, they are supported by robust balance sheets and strong earnings growth momentum, which enables them to withstand any downturns with ease. So these companies, they often also possess competitive advantages such as global leadership, network effects, things that make it very hard for you to stay away from their products and services. Many of these companies, they are also at the forefront of the AI boom, which we expect to endure despite economic uncertainty at this point in time. And besides big tech, another sector that we really like is also semiconductors. I'm sure that many of you have heard this before from me already. Semiconductors, basically, they are the bedrock of all modern technology. And as the world becomes increasingly digitalized, we should expect demand for semiconductors to rise along as well. And on top of that, the semiconductor industry, it is relatively small and highly specialized, which also means that there is significant barriers to entry. This protects the incumbents from new entrants and also supports long-term structural growth. So overall, our stance for the digital economy is that it will play an increasingly important role in the global landscape, and with that comes significant potential for share prices to rise in the long term. Now moving on to fixed income. So for our intra-asset allocation, for many global bond indices, they follow a market value weighted approach, meaning that they allocate heavily to US government debt. As you can see from the chart on the left-hand side, the majority of the bonds inside the global aggregate index, they are actually US bonds. Now, while the US bond market is certainly one of the largest and most liquid in the world, it may not be the best fit for Singaporean investors like us because it leaves us heavily exposed to currency risk. So currency risk, it is an important consideration because it can be significantly impacted by fluctuations in currency, such as the recent decline in the US dollar, which is why our approach is different. We carve out our fixed income allocation from the lens of a Singapore-based investor. So the right-hand side actually shows you the actual fixed income allocation for our MAPS portfolios. As you can see, we prioritize Singapore-centric bonds, which makes up roughly 30% of the total allocation. On top of that, there is also some Singapore bond exposure coming from the Asian IG bond segment, which is about another further 15%. Now, if we take a look at the types of bonds in our portfolio, we first have to recognize that the primary role of fixed income is to provide stability, as bonds generally exhibit lower volatility compared to equities. So this is why we have placed a greater emphasis on investment-grade bonds and less of an emphasis on the riskier segments such as emerging market bonds and high-yield bonds. In fact, IG bonds, they make up roughly 65% of our fixed income allocation. So that being said, we have also allocated a small portion to the high-yield bonds. While these carry higher risk, they offer the potential for greater returns. And by incorporating both IG and high-yield inside our portfolio, we aim to strike a balance between managing risk and pursuing growth, ultimately providing investors with a more complete and holistic exposure to the overall bond market. Now, once we have completed the intra-asset allocation, we'll move on to step 3, which is the product selection. So while our fund selections, they may vary based on our market outlook and also other factors, our focus list, such as the ETF focus list that was shared by my colleague earlier this morning, and also our recommended funds list, which we are going to publish in a few months' time, these lists, they guide our product selection as they represent our top choices for the best UTs and ETFs that iFAST has for you. And depending on the type of exposure that we are targeting, we may choose between a unit trust or an ETF. So in some cases, we might use an ETF when the exposure we are seeking is more specialized, such as semiconductors, for instance, where there is also a lack of actively managed funds in this space. And on top of that, we may also select ETFs where we find that in that particular market, active fund managers have been underperforming the index. So speaking of our focuses, I would just like to briefly go through the selection process for both UTs and ETFs. So I think one of the key quantitative factors that we consider for ETFs, for UTs, is the fund performance. So while past performance is not a guarantee of future returns, I think it still can offer valuable insights into a fund manager's skill, strategy, and its ability to navigate various market conditions. So if a fund manager is able to consistently outperform the market or peers, it is a strong indication that something is going right with his strategy. And for that, we look at both calendar as well as cumulative returns for a more holistic assessment of returns. So in addition to this, we also look at downside risk metrics, such as the maximum drawdown as well as the volatility of the fund, to gain a better sense of the fund's risk-adjusted returns. So performance is only one part of the equation. We also evaluate the fund's expense ratio to ensure that fees, they don't erode long-term returns. And the qualitative side, we work very closely with the fund managers in Singapore. So we speak to them constantly about changes in their products or their strategies. We stay up to date with their any new product launches that we have. And I would say many of our fund houses, they are all very proactive in reaching out to us, and they are also very responsive whenever we have questions for for them. So it is also very helpful for us in our decision making to when we decide what funds are we going to include inside our MAPS portfolios. Now, turning our attention to ETFs, I think my colleague Joel has already covered most of the ETF selection methodology, so I won't go into the details again. But broadly speaking, for ETFs, we place more emphasis on the expense ratio because ETFs, they are meant to be low-cost instruments. The lower the expense ratio, the higher your returns, all else equal. And even a small difference in the expense ratio, it can impact your longer-term returns significantly because of compounding. And besides lower expense ratios, we also favor ETFs with higher liquidity as it allows investors and also our portfolios to enter or exit the markets with less of a market impact, which leads to better pricing. And on the qualitative side, we pay attention to factors such as the choice of index, the exchange listed, concentration risk, replication method, so on and so forth. So the final step in our process is review and rebalancing. So this is not really a step, but rather an ongoing process. Markets change, economic conditions shift, and portfolios need to adjust as well. So over time, market movements, they can cause our portfolios to drift from their intended allocations. They also, which in this case, we will trigger a rebalancing to bring the allocations back to their neutral allocation. So at times, we may also make fund switches for our portfolios should we find that certain funds are underperforming or if the fund manager's view is no longer aligned with ours. And again, we don't trade based on news. More importantly, we make adjustments that are based on structural factors and we stay true to our fundamentally driven long-term investment strategy. So we find that this approach, it helps to take the emotion out of the equation and keeps us focused on the portfolio's longer-term objectives. So I hope this has given you a clearer understanding of how we construct and manage our portfolios. Before I sum things up, just let me give a quick overview on our positioning. So for our inter-asset allocation, we are currently neutral across all 5 risk profiles. Right now, we find that the earnings minus the bond yield spreads, they are currently slightly above 0, which also suggests that equities are not offering a significant premium over bonds for the additional risk taken. So this is not surprising given that global equities have, after a rough start at the beginning of the year, are trading close to their all-time highs already. And on the other hand, our outlook for fixed income, it remains uncertain as well. So ongoing concerns about tariffs, inflation, and also the potential path of interest rates, it continues to cloud the picture for bond markets. So overall, we just don't see the strong case to overweight either asset class, which is why we have chosen to stay neutral across our portfolios. So for equities, we are currently neutral on Japan. I think 𝐓𝐶 has done a good job earlier summing up Japan already, so I won't touch on this. I'll move on to the US. While we are underweight the US, we are actually neutral on the digital economy. So although valuations for the digital economy has risen as of late, it still remains a compelling investment theme backed by structural tailwinds and robust earnings growth. Besides the digital economy, we are also positive on other markets such as Europe and Asia ex-Japan. So Europe, for instance, the outlook has improved significantly, supported by a wave of fiscal and monetary stimulus. Germany's lifting of the debt brake is also expected to unlock billions of euros in fiscal stimulus for the economy and also in terms of defense spending. And besides Europe, another market that which we have recently turned a bit more positive on is China, which 𝐓𝐿 has explained earlier. And finally, for our fixed income allocation, we have opted for a more defensive positioning given the vast amount of uncertainty that we see in markets right now. So the majority of our fixed income exposure, it continues to be anchored by shorter duration bonds and investment grade bonds, which we think will continue to do well in the current environment. So despite rate cuts, you see short-term interest rates, short-term bond yields, they are still relatively attractive compared to longer-term yields. Rising inflation expectations and mounting concerns over the US fiscal trajectory is continuing to exert upward pressure on bond yields, making longer duration bonds less attractive on a risk-reward basis. So as such, we remain cautious on duration and we prefer to stay positioned in the shorter part of the yield curve. So if I were to sum things up, I think long-term bond yields, they are still not offering adequate premium for investors like us to take on additional duration risk. And our preference is really to see a further yield curve steepening and perhaps for the 10-year US bond yield to reach the 5% level before we consider adding duration. And in terms of credit quality, we continue to favor investment-grade bonds over high-yield bonds for their defensive positioning. So such bonds, they offer greater stability and resilience amid ongoing market uncertainties, effectively fulfilling their role as a portfolio stabilizer. And although high-yield and investment-grade bonds are trading at tight credit spreads, we do expect spreads for high-yield bonds to widen further should economic conditions deteriorate. And yeah, like Colin mentioned, I think the spread between the yield pickup between high yield and investment grade, it remains extremely tight at this point in time, and we just don't see we just don't see the point of going into high yield and taking on the unnecessary credit risk. So overall, all these factors, it underpins our preference for investment grade over high yield, especially as we seek to balance the potential for higher returns and downside protection. Yeah, so to wrap up, our managed portfolios, they provide a more convenient way for you to invest. So if you are new to investing or simply just don't have the time to monitor markets, I think MAPS could be a solution for you to consider. So with that, ladies and gentlemen, I've come to the end of my sharing today. Before I end, I'd just like to wish everyone all the best in your investing journey.